Good morning. We try to understand things here in a systemic way. That is, one part of a supply chain, for example, impacts everything in that supply chain, and how a dysfunction in one part of an economic system affects the whole. And how, if we look closely, that events that seem unrelated are actually very much related, maybe even causative. That is, there's a cause and effect relationship between two events that seem to be happening in isolation. Here is an article about how countries in the Gulf states, the Persian Gulf countries, Saudi Arabia, the UAE, and Qatar, they're named here, and they're working together and working with China to set up direct swap lines denominated in RMB, the Chinese currency. And here are two pieces from recent Treasury debt auctions: a $42 billion 10-year auction on 13 March, and an auction for $67 billion worth of 5-year notes from 26 March. And here they say the indirect buyers were 64%. On this one, they were 70%. Indirect buyers are foreigners. They're going through foreign broker dealers or foreign banks. Sometimes they're foreign central banks. And so here, if we do a little math, total auctions here combined was $110 billion or so. And about 2/3 of that came from indirects, foreign investors, which is $70 billion. Looking at things another way, when the US government needs to borrow money, about 2/3 of the borrowing in these US dollars are abroad right now, and they're coming home to feed deficit spending there in the United States. So just for these two bond auctions, $70 billion is coming out of banks here and going there. And just this year, we will have to refinance over $10 trillion of maturing debt and finance another $3 trillion or so in new borrowing. That's about $13 trillion. And if the percentage of financing is coming from abroad at about the 2/3 rate that we've seen the past few months, that's about $8.586 trillion that are overseas right now that will be pulled out of the banking systems outside the United States to go home. This is going to make inflation in the United States much worse still than it already is. And there is a lot of noise here that makes the math a lot more complicated. The US is also running $1 trillion a year deficit in trade deficits with the rest of the world. So that money will be coming back to foreign banks, but that will happen over time, gradually. We also don't know how much of this maturing debt will be put out to investors abroad at maturity, who will simply roll it over again. So some of that $10 trillion might be just in and out and not move the needle very much. We just don't know. But all these US dollars that are held abroad are used by buyers and sellers doing business. And those dollars are leaving the global banking system. And there's nothing to replace it, because liquid US dollar reserves, which are usually either cash or very short-term T-bills, are being replaced by 5- and 10-year bonds. And those cannot be lent overnight to make trades go. And we have another situation then that has never happened in the history of the world. Inflation is terrible in the United States, and it's getting much worse. There are too many dollars there. But ironically, US dollars are scarce in many overnight markets. And this is going to get a lot worse too as we move through the year. There are way too many dollars in the US, and there's way too few out here. These are, after all, very clever people working in Dubai, in Riyadh, in Tokyo, in Beijing. Their economies, their economic survival, literally depends on being able to trade freely with other countries. And we, the United States, we are already giving them lots of reasons to worry. And now we're taking the dollars away and sending it to Washington to fuel deficit spending. There are many factors now that are pushing countries away from a preference to do business in USD. Economic sanctions against countries and against companies, these send a very strong message to almost everyone that it's risky to have their sovereign currencies in a central bank connected to the SWIFT system, let alone to have their FX reserves, their foreign exchange reserves in USD. Literally anything can happen at any moment between governments. And could that money be seized? It just adds a very high degree of uncertainty. It also isn't helpful to have our officials fly to other parts of the world and tell them that they need to do business differently, and if they don't, we can sanction those countries and companies that we're not even in countries that we're at war with or at war at all. We just don't like the fact that they're making a lot of money. Those are bad enough, but what is happening in the foreign exchange markets now is a redress, a reaction to a deeper and even more fundamental problem, which is that even for countries that are willing to take these risks and use US dollars for third-party trades, the dollars aren't there. Here, we have countries that are friendly to the United States. Saudi Arabia is an ally, at least notionally. Qatar, they're an ally. And they're realizing that their survival, the ability for them to trade, is contingent now on setting up trading regimes that are outside the dollar. They have no choice, and we're giving them no choice. We are paying their investors 5% per year now to lend us the dollars back, and they're showing up at our treasury auctions to buy our paper just like we need them to. But every time they buy our bonds, there are that many fewer US dollars in the system to fund outbound oil sales in the case of the Gulf states, or in China's case, outbound industrial equipment sales, or in Brazil's case, sugar, or in Chile's case, copper. These countries are friendly. They're not unfriendly. They're our friends, and we're telling them to use dollars to trade with each other, but we're draining them out of the system. If we put ourselves in the position of a very close country, Australia. Australia is a Five Eyes country. We have a mutual defense treaty with Australia. But Australia's biggest trading partner is China. New Zealand, same thing. China is their biggest trading partner too. It's not only that China strongly prefers to do business in RMB, and they do, and they are making it easier to do so on the one hand, but on the other, Washington and Wall Street are taking away all the dollars that are needed outside the US to buy and sell. If today Saudi Arabia is setting up swap lines, Saudi Rial for RMB, what's going to stop Australia from doing it tomorrow? And New Zealand the day after that? And Canada next week? We are stuck. These are deeply structural problems now, systemic problems. And even our friends now are saying we need alternatives to the USD, or they won't be able to do business anywhere with anyone. The entire US dollar system is being chipped away week by week, auction by auction. Here is the Treasury calendar. This is just April. Here's May. Literally every week, 3, sometimes 4 auctions a week. With indirects at 60% plus, there's $1.5 trillion right here. So here's $950 billion in the next 6 weeks that's coming out of the system. And Washington is just bleeding the US dollar system dry across the whole world. And we see now how the world is responding by setting up another system. Thanks. Be good.